Welcome, everybody, to the Chinchilla Pickin' Podcast. It is May the 1st, 2023 at 7:37 p.m. As always, we hope to be entertaining, educational, and uplifting because we want everyone to make money. My name is David Underwood, and as always, I am joined by Brandon Beaver. Brandon, how are you, man?
Doing all right. It was a crazy week. One of the reasons why we didn't have a show, I got sick, as I do oftentimes this time of year. But we are back. What is crazy to me here, we didn't have a show all week last week, and our numbers have just been going crazy on this podcast. I stopped promoting it on TikTok. I haven't run any commercials or any videos or anything like that. Our listenership has more than quadrupled in the past couple of months, which is awesome. And at the same time, in the past week, our subscribership doubled, and we didn't even have a show. So thank you for listening to us, even though we didn't have a show. I don't know who's sharing this podcast. Somebody's doing some word of mouth stuff, and we absolutely appreciate it.
Yeah, I do also want to piggyback on that. Hey, we appreciate that, guys. We love that you're listening. We apologize first and foremost. We apologize for not putting out a show last week. Brandon and I both were A, sick, and B, we had a lot going on in the personal lives, but the sickness really tears into us. That reminds me back when we both had COVID for 2 weeks and we couldn't put out a show at the exact same time. So I mean, there was a lot of complications going into it, and then yeah, so we appreciate you guys listening. We appreciate subscriber growth. If you're a new listener, that isn't normal. We're usually pretty consistent week in, week out with at least one show per week. And even every now and then we've done like little mini shows, like a break with Brandon or downtime with Dave. And we've done those mini shows as well. So yeah, keep listening. We appreciate it, Brandon.
Yeah,
What's going on?
so I got my main gig right now at Total Quality Logistics. That's where I work, and you can email me bbeaver@tql.com if you have any freight for me, by the way. And
Wow, shameless plug.
the good thing about this, listen, like freight's in a recession, which is really tough for a lot of people, and you may think I'm Johnny come lately here, but like I'm putting a lot of work into it. So getting new clients and things like that, and moving forward, which is awesome. One of my clients that I just closed a couple weeks ago, Bascom Hunter Technologies, I wanted to give them a shout out. They're in the aerospace and defense sector. They're very innovative in what they do. They're in trade shows all across the country all year round. They're down in Baton Rouge, Louisiana. So if you're near there and you want to do business with them, if you're in the aerospace industry, definitely work with them. They're great people. Go ahead, Dave.
I believe it's Baton Rouge.
Baton Rouge.
I don't know. I can't speak Cajun. I try. I try. Nice. So
I
we appreciate
understand it.
right.
Yeah.
Right. Appreciate the shout out. All right, guys. As always, the rules. If you're a new listener and you haven't listened to us before, we have rules. Brandon and I get together 5 to 10 minutes before the show, and that's it. We just tell each other what we're going to talk about. We do not discuss it. You guys hear the live back and forth here on the show. That way you get that real feeling of us discussing, talking our way through these things that happen. News, maybe it's earnings, who knows? But Brandon's taking off first. So Brandon, what do you have for us, man?
So let's do, you know what? I've got a little victory lap that I got to do, and then I've got some crow eating to do too. So,
I love the crow.
Meta stock. We've been screaming buy on this for a long time, and I'll get into whether or not I think it's still a buy here. But look, back in February, this is a surprising statistic I found out today. Back in February, after it reported its previous quarter's earnings, it rallied 23%, which was its best day since July 2013. We're now up around 70% year to date. And that's because Meta reported $28.6 billion in quarterly revenue, $2.20 per share. That just knocked it out of the park. The estimates here were 27.7 billion in revenue and $2.02 respectively in, per share count. Revenue was 3% year over year, but that caught a lot of people off guard. They were expecting it still to be flat or to be down year over year. So Meta rocketed 10% after hours following the report. just had a really good day. You know, we're 70% year to date on it. Here's where I want to suggest that we should have some temperance in our excitement for Meta, though. Now that we've had this rise year to date, still has a $4 billion loss for the year in augmented and virtual reality. So, and that was actually worse than analyst expectations. And 30% larger loss in the segment in the first quarter of last year. So 30% larger loss than it was last year. Go ahead, Dave.
All right. So a couple things here. I do want to talk about the virtual reality, augmented reality, just because if you've been listening to the show since the beginning, you understand I have tons of VR sets here. I am big VR'd out. I have lots of gear. I have vests, everything, gloves, all you can name it. But we'll get into the VR here in a minute because I there's some more behind it than what you're reading into. But I want to talk about the headline numbers, top line, bottom line numbers. So the top line numbers of revenue actually did not grow that much, but they were able to shave some costs, and that's why the bottom line grew. And it's just a cost savings by Meta, being smart with their money, being smart by planning for the future. Everybody was expecting a downturn in the economy, but in the first quarter earnings, everybody was expecting it to start in the second quarter, and it has not started yet. And so what I'm wondering is, are we still expecting the slowdown in the economy to happen, or do we think the U.S. economy is just still too strong no matter how fast inflation falls? You know, this is just never going to be the slowdown that everybody's expecting, because on these earning calls, this is what I'm hearing. Every single earning calls, we're expecting a slowdown in the economy. We're expecting a slowdown in the economy. When I talk about oil later on in this podcast, people were making cuts because they expect a slowdown in the economies. I'm not seeing the slowdown for a company like Meta. I'm seeing it stay plateau. I'm seeing the plateau with their numbers.
I think all evidence still points to yes for a slowdown in the economy. And I think the tricky thing here, it's not the if. The if I think is pretty easy to to say whether it's going to happen or not. I think it's pretty easy to say that yes. The tricky part is when.
So in
That's
a
all
company like, all right, so my question in regards to Meta, since their top line number, their revenue is flat, right? When if you're listening and you don't understand, top line number means that's the revenue a company brings in. That's before they take out for any kind of costs, any kind of overhead expenses, any all that. That's just the amount of money they bring in gross. So the top line number for Meta was flat, even with these cost savings. So if the economy is going to turn down, that usually will mean that their top line number is going to fall, if I'm reading this correctly, because right now the economy hasn't turned down and it's been flat.
Or a lot of business executives have already predicted that it would fall, and the result has been a decline in advertising spending, maybe more than what they needed to cut.
That's also a good outlook. Like, so you're saying, let me again, I always like trying to explain this to, like, I'm trying to explain this to a child, if you will, because I believe you don't fully understand anything unless you're able to explain it to a child. So what you're saying is that companies were foreseeing, like, all fourth quarter numbers like that we saw the in the first quarter, like, and in the end of actually the third quarter numbers we saw in the fourth quarter last year. All the CEOs were coming on these earning calls and saying, hey, we're going to have a tough economy next year, where it's going to be tough. It's going to, we're going to see a slowdown because of the inflation, and it's dropping so fast. And we've heard the same thing from all these CEOs. You're saying that the CEOs then told their advertising budget, hey, let's cut our advertising budget a little. We don't want to spend so much on that. And that hurts a company like Meta, who makes most of their profits off of advertising.
Right. And we're seeing the same thing in the freight business right now. So,
Gotcha.
But yeah, I think that's it. But they've also actually increased their forecast for cuts again. So they're gonna cut costs by another $3 billion. They announced that this quarter as well, and that's for 2023.
And that's crazy that they're just shaving what 4,000 workers and it's 3 billion in savings. How much are you paying these people? Can I get a job there?
But it's now actually been more than I think 10,000 employees now that I've
Okay, all right. That's
now,
so
that's another thing, another reason why this went up. It was another $40 billion buyback announced for the year. And yeah, I gotta tell you, like, I like the buybacks as a shareholder, but man, that's just not good PR.
right. Well, the buybacks, I think, and we talked about this on the last show. The buybacks are because of the new, the current administration's rule that's going to maybe take effect here soon, which is that they're going to have to start paying taxes on these buybacks, or they're going to be penalized. They'll be penalized. That's it on the buybacks, and so there are companies I believe are trying to get these buybacks in now before that takes effect.
Yeah.
That's what I think the thought is. That's why you're seeing a lot of buybacks currently. It's not above and beyond the normal cycle of buybacks that you typically will see. My question for VR, since I know you've delved deep into Meta, you've looked at lots of their numbers, you understand this company back and forth because you've researched this back and forth better than I have. I will admit that fully right now. But my question for VR, I think that Zuckerberg went so far so fast with VR that he went beyond what his consumer base was. So they had a hit with the Oculus Quest. It jumped into like the number 3 spot there for just a brief short period. We talked about in the show when it did. It was just for like 3 months. It jumped up there and then fell back down. Right. Yeah. They finally had a hit game that sold millions of sales for that one game, and we talked about in this show and how it was the VR system is actually going to take effect here and become a console system that people are going to use. But then they were stagnant for a little bit. There wasn't any real big games coming out. There wasn't, without content and without a new console, a gaming system like an Xbox or a PlayStation will die. You got to keep bringing out content. You got to keep bringing out new things. No, nobody wants to wait for Grand Theft Auto if it's going to be another 10 years before they see a game, right? So,
since 2013 on that one.
Right? So, this is what you have here. And so when he finally did come out with a console, it was so overpriced and overdone, and it was mainly for people who were more into a professional or a working way of using it, and not the casual gamer. And the casual gamer couldn't afford it.
They've already cut the price on it too.
I know, and it's still overpriced, I believe, for a casual gamer. This is something for a business, a company, a small business, something like that. And I think that's what hurt him, is the direction he went in, and he went so fast, so forward, so quickly that he just charged full steam ahead without looking back and saying, "Hey, are we on the right course?"
Yeah.
And I think that's what he needed to do, was slow it down and ask the people underneath him some questions. Say, "Are we on the right course here, guys? Tell me if I'm doing something wrong." And I don't think he was doing that. I think he was wanting to charge too fast.
Yeah, and there's no financial benefits in business for being too far ahead of your time.
Right.
It's just not.
Besides history saying that, hey, he was so far ahead of his time.
Yeah, look at all the tablets that failed before the iPad.
Yeah, right.
Yeah.
Palm Pilot. Where's your Palm Pilot at, man?
Right. that actually was something that was beneficial, but there were tablets and kind of versions of MP3 players and stuff like that before the iPod that just didn't do anything.
Right. Yeah.
So, I think this is kind of the same thing with the metaverse, but he does say, we're looking about 9 to 10 years out before the metaverse plays out. I think it's probably 8 years now because we've been talking about it since the start of the show. But
right, we have. So here's my question then. In regards to Meta, you were talking about you're being hesitant going into the rest of this year, but you have consistently held a long-term view on this and a long-term buy on it. Are you still diamond hands on this, or are you now saying that you're concerned about the second half?
So I am a little concerned about the second half, but yes, I'm still diamond hands on it. I think that we can expect, if you bought it right now, if you bought the stock right now, you could probably expect about inline results with the S&P 500. You're not buying it undervalued. You're not really buying it overvalued. It's fairly valued at this moment in time. The price to earnings ratio right now is up to 28 times. When we were screaming buy on this show at the beginning, it was around 10. So I mean, we've came back up to fair value on it. Price of sales just over 5. That indicates a possibility of it being a little bit overvalued, but sales are temporarily down because advertising's temporarily down. So that kind of makes the price to earnings ratio and the price to sales ratios go a little bit higher than what they normally would be. So I think you're kind of fairly valued right now. I just if you don't have it right now, I would wait for another pullback in it because we're up, 70% year to date on it. 20, it's like somewhere between 15 16% for the last week. That 23% surge after February, I'd hold out. It's overbought right now. I'm keeping it, but I've got a great what Warren Buffett would call a margin of safety, or Benjamin Graham, the intelligent investor, he would say a margin of safety on it. So I've got a good margin of safety, around like 167, 169 or something like that where I bought it at. And so I'm going to hold it because I think it's a great long-term, play. If you bought it now, held it for 5 to 10 years, you'd probably still be happy that you bought it now, but buy it now, a year from now, maybe not.
There you go. Cool. Thank you, man. You answered my question.
Yeah, thanks. Okay. So Dave, before I talk about Activision, do you want to go next?
No, go ahead. Talk about Activision because I have been bitter with Activision since last year where I had to hold it for 6 months in order to eke out what I think I did like a 2% gain. I don't even know what it was. It was a pitiful gain for 6 months. Tell me about your Activision stance right now, Brandon.
All right, fine. So here's the thing. The UK Competition Authority stepped in, and it's actually the UK regulator, the Competition and Markets Authority, temporarily at least, have blocked the merger between Microsoft and Activision. The acquisition there may not happen. It's probably not going to happen, not at least the way that we know it right now. And in fact, it may not happen at least for 10 years, which means that it won't happen at all because the prohibition here on, I think this is page like 336 or something. So here's what it says. Prohibition would be affected by accepting undertakings under Section 82, the actor making an order under Section 84, blah, 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 blah. This prohibits a merger and preventing the parties from attempting to merge for a further period. Our normal practice would be to prevent a future merger between the parties for the next 10 years, absent of circumstances. Honestly, I think it was a terrible ruling. This does not make it would not make Microsoft in any way a monopoly. I think that the UK Competition and Markets Authority wanted to make a name for themselves because it was assumed that they may, be light. They may not have the power to have, to make these kind of rulings after separating from the EU. I think they're literally just trying to make a name for themselves, and I think it's a sham. Google and Sony have put a lot of money in trying to stop this acquisition from happening. Now, here's the crazy thing about this: Google's not even in gaming anymore because they announced that they were taking away their gaming platform, which was in January, and this was a pay-to-play gaming platform where you had to pay for the games and you had to specifically stream it across their service. That didn't work out because people don't like pay-to-play. It didn't work out because people didn't like to have to specifically stream it on Google. And, Google really being afraid they can't step back into that market again if Microsoft acquires a powerful gaming company like Activision and doesn't allow them to specifically stream it on their platform. This is not something that helps consumers. If a big company is stepping in and blocking it because they don't want, to have the potential that they can't specifically stream a game that you buy on their own platform, I don't understand how this helps anybody. Go ahead, Dave.
All right.
Tell me if I made any sense on my rant there. Did I?
No, yes and no, yes and no.
Okay.
But here's the thing I want to point out. There was a couple articles I also read today on this, and they were saying that if Microsoft cannot acquire Activision, if this is completely blocked everywhere now, then Microsoft may not be able to make a profit in the gaming industry, and they may be negative, and it may cause them to disappear. And now Sony is a monopoly, and I find it funny that it's antitrust that is going to stop Microsoft from acquiring Activision, which actually may create a monopoly in Sony. The irony is so thick here.
There may be corruption in the ruling. I don't like. I'm not trying to take it too personally here. I took like a $2 loss on it, which that's not terrible. It's like 0.3% or something stupid like that. But I sat on it for 6 months, and at one point I was up 13%. So
now you sat on it longer than 6 months. I know, because we've been talking about it on the show for about a year.
Yeah, whatever.
Hey,
let me talk a little bit about Activision here. Net bookings in the previous quarter were up 25%. GAAP earnings were up 70%. Great quarter. Great business for them. Right now, business is doing really good. If the deal fails, which right now it's looking like it will, Microsoft and Activision are working on an appeal. They've got a few other strategies in the works to try to maybe move this deal around so that it does get approved by the UK. But if it doesn't, Activision collects $3 billion from Microsoft. They'll be sitting on $18 billion in cash at the end of this year. 99% of the time, with any other given stock, I would say buy this right now. I wouldn't care if Microsoft was going to buy it for $95 billion. But the CEO, Robert Kotick, has been so bad for employee morale. I mean, you're talking about like accusations of rape, accusations of potential contract for murder, and threatening people's lives. I'm not touching it with a 10-foot pole without Microsoft. And now that it's up in the air, I took my losses.
Yeah, the deal was Microsoft would come in and buy it, and they would get rid of all those top leadership that caused these. These are just accusations and allegations. I never want to say that anything is true that I do not personally know anything about.
We don't know.
You're right. But the fact that there is so much there, yeah, you don't want to touch the company without Microsoft buying and removing those in leadership and power. So to me, I'm staying away from currently Activision and this deal. Now, Microsoft, separate and apart from that, from the gaming industry, I do like Microsoft as a company mainly because of the cloud business and their military contracts.
Me too.
So I like Microsoft as a company from that aspect. The cloud, the military contracts, their software sales are still strong, so that's a good part of the business. But they're just making money hand over fist on the cloud. It's ridiculous how much they're pulling in. That's a big part of this company.
Yeah, it makes me sad for the Activision employees because now they may not, be acquired by Microsoft, which has one of the best company cultures in tech.
Exactly. All right, man. Do you mind if I jump in here with some things going on?
Yeah, sure. Do you mind if I edit out the last 10 minutes of us talking?
No, I don't. You're gonna have to put in there that you got it wrong. It's okay. I get stuff wrong. Didi, come on. I got Didi wrong.
Dude, the last 3 episodes I've been saying buy Activision. It's been like my only call, and so for this to happen, I mean, it caught everybody off guard.
It did catch everybody off guard. We all get something wrong for sometime, and I think it's good for our listeners to hear us admit when we get one wrong. You know what I mean?
Yeah. All
right, guys. So I want to talk about and there's a couple different angles I want to go with this here. One of the ones I want to go is it's weird. So Lordstown Motors. If you guys don't know what this is an electric car company. So when Tesla came out and they started selling lots of cars, and the Tesla was actually becoming successful, all these other companies started coming out, started saying they're going to come out with cars, right? You had, was it Lucid, Lordstown, Rivian? There was one, was it Pear or something? I don't know. There was a lot of different electric car companies that just started popping up out of the woodworks. Everybody thought, hey, if Tesla can do this, I can do this too. So you had a new industry coming into effect. And what happens whenever you get a new industry is you get lots of new companies, and then you're going to eventually going to have some consolidation where some of these companies fail because you can't have that much competition for too long before eventually some people just drop out, right? Well, Lordstown Motors was written off a couple years back because they had some issues. We reported on the show. This was 2 years ago. And they had some issues, and everybody thought, okay, this is going to put the nail in the coffin for this company, but they survived and they kept going. And it was looking like, okay, maybe they could actually turn around from these issues that they were facing. It was supply chain issues, it was financing issues. Well, one of the financiers of this company is Foxconn. Now we all know Foxconn is usually they work out in Asia, and that's where Foxconn makes its bread and butter, is building things and selling them cheaply in Asia, cheap labor, right?
Tech.
So,
Microsoft, Apple, and
Lordstown Motors shares tumbled today, closing 23% lower. And I'm just reading straight from the article right here. After major shareholder Foxconn alleged it breached their $170 million investment deal, an electric truck maker warned it might be forced to file for bankruptcy. So now it looks like that Lordstown might actually have to file for bankruptcy, and this might be the end of them, right? So Lordstown was saying they were in talks with the company. It rejected Foxconn's allegation of the breach of agreement, saying that the claim was based on delisted notice that the NASDAQ sent the Ohio-based automaker, right? So they delisted from the NASDAQ, and that was a breach of contract with Foxconn. But Lordstown saying that, one point they tumbled actually 50% today. But they ended up closing at 40 cents, which was down 12 cents in heavy trading. This is a penny stock, guys. This is really awful here. They actually sold their Ohio factory to Foxconn in May of 2022, and I think that's Foxconn's play here. Is Foxconn now owns the factories that Lordstown Motors makes, and they're in Ohio. And I think Foxconn may actually be trying to push, either own the rest of this company or push Lordstown out and just take the infrastructure, because they're going to say, we gave you all this money, you're filing for bankruptcy, we get the factory, and we get all these other things.
Well, I mean, they own the factory, which is good, but what else do they get besides the hollow pieces of tin that they rolled out in front of people to pretend like they were actual cars? Wasn't that Lordstown Motors that did that?
Yeah, it was.
It out like, oh, look how great this is, but then people opened it up and there's nothing under the hood. There's nothing there.
They had a number of scandals early on. Well, not scandals. They had a number of missteps for a new company early on, is how I'll put it. I'll put it nicely that way. And that's why, like, I was just like, this is just awful. This is a company that just popped out of nowhere. And I thought that I'm like, this is turning into like a shell company that's just going to take money from shareholders and investors who want to make a quick buck off an electric car company. And I said, they ain't going to do nothing. And that's what I was thinking at the time. I didn't come on the show and exactly say those words, but I was very harsh about them. And here we are 2 years later, and they're saying we're going to have to file for bankruptcy. We can't maintain this. And it just, it goes to show you guys, when you smell something out early on in the company and it's just trouble after trouble after trouble after trouble, they're not going to last too long if they don't have a base, and they have not been around a long time and have that big name and those people willing to buy for them. Like Bowen, I somehow was able to survive all their missteps, but who else are you going to go to? There's Bowen, there's Airbus, there's not a whole lot of players in that field. Lockheed Martin can keep up somewhat, but there's not a lot of players in that field. Here, there's a lot of players. So Lordstown's just,
stay away,
go somewhere else.
Stay away from idiotic valuations.
Right? That, like the space program, the Virgin, idiotic valuations. We talked about this with the Virgin Space Galactic program, and how the valuations caused the whole thing to fall. If I start a company and I have this great idea and I come out there and it's revolutionary idea, and Brandon, you come up from a bank, you're like, hey, this guy Dave over here, he's got this $10 billion idea that's working really well. And I'm like, oh, great, give me a loan for $8 billion based off my $10 billion valuation. That's what's happening with these companies. And it turns out the companies aren't really worth that 10 billion. So now how are they going to pay back this 8 billion, which they don't have any equity or no infrastructure, nothing in place to pay back that 8 billion. And it just blows my mind. It blows my mind, Brandon, because I just think back to like 2008 and Bear Stearns. It was Bear Stearns when someone bought Bear Stearns for $2 a share, which was less than what it cost for the actual skyscraper in New York that they owned. And it was just awful. But here we are. We're given a company that comes out with this shiny new thing, $1 billion of valuations, and they're not really producing anything. They're not doing it. They don't have anything worth that.
No, and that's honestly, that's the majority of companies in new industries when they pop up. So that's why you have to be so careful with it, you know, and it's one of the reasons why I sit on my hands and wait for things to play out sometimes.
Yeah, and that's a good play, and that's a good thing to do in those regards. And that's kind of where I wanted to go with this was, you know, we have to take our time. We have to make sure that what we're doing is the right thing to do, and not just jump on the next hot thing because, hey, this is what we're meant to be doing. This is the coolest thing out here. I remember when the marijuana companies were all coming out and everybody was buying up, was it Tilray, Aurora Cannabis, and all those other. Remember when Tilray was over $100 a share? And it dropped all the way back. It dropped all the way down to like less than 10. And I think last time I checked, it was like at 15 or something. But it was over $100 a share at one point. Aurora Cannabis was getting up there in near 20, and you know, it was just a big run on the marijuana companies, and then they fell off, and some of them disappeared. And it's always the same kind of cycle that you see when you have these new sectors that are invented and created, and everybody wants to invest in the newest and hottest sector and drive up the price. Eventually, those are gonna, so a lot of those are gonna fall out and disappear, and you know, there's only gonna be like one or two that stay.
Well, you talked about the space industry last episode we did, and Virgin Galactic, same thing.
Yeah, exact same thing. And it's just awful to see. But I mean, I hate for people to lose money on things like that. But that is the way it is. Things to look forward to, guys. I want to cover a couple things.
One real quick. Sometimes that's how you have to learn your lesson, and if you did, hopefully you learned it.
Right? Yes.
Yeah.
That's exactly it. So one thing we're looking at this week, guys, and everybody's looking at is the Fed meeting. We want to know what's on the Fed's mind, because that's our big movement. With the inflation rate dropping down to 5%, does the Fed believe it now is the time to stop and halt and seize? I don't think so. I think they're still going to do a 25 basis point. They may pause. They may not do anything, but it's going to be either 25 or nothing. I don't see a 50 basis point now that they dropped over 1% in 1 month move. I think they're going to slow down. That's my thought. The futures are down right now because, and all the headlines I'm reading right before we got on here, Brandon, was all about the Fed meetings. I saw some headlines about the the June 1st deadline for our budget. The government shut down again. So we have that looming and paying our debts. But I think we have a whole month before then. Congress always ends up working this out. So they'll work that out. I'm not too worried about trading off of that or investing off of that. That's not top of line. The Fed, hearing what they have to say, actually makes me want to pause and listen. And the other thing I wanted to talk about was, you know, everybody's saying they're staying away from these regional banks because of what happened to First Republic and how the FDIC the SEC had to secure it and seize it. And then JP Morgan is just buying up the little bits and pieces of the bank that was left over. And so they're like, you know, we want to stay away from these regional banks. And I'm like, yeah, some of these regional banks are really strong. They're not all First Republics. First Republic just was completely hit by the Silicon Valley and the Signature banks. It trickled out into First Republic, and that's what really caused that to fall. And the SEC came in and really saved those accounts there. And so, you know, I don't believe there's a contagion for the other regional banks, such as a Fifth Third or PNC. I believe those are all safe and strong, and you can invest in them, especially PNC. I like PNC a lot. I think they're well run. They're a good bank. And that'll be one I'll be invested in. Brandon, thoughts on these things?
Well, PNC is one of my favorites too. Charlie Munger just came out and started ringing alarm bells with everybody else on the commercial property sector. And we did an entire show on that a couple of shows ago, 2 or 3 shows ago, I think. And now Mungie Pants, as our friends over at the Money Vikings like to call him, came out and he's saying the same thing. The commercial property market in the United States looks like it's going to have a tough year ahead.
Hold on. I want to interrupt you here because I want to toot my own horn. So what you're talking about was I brought up was saying I was like, I've been saying this now for about a month, or a little over a month now. It's been 2 weeks since our last podcast. About how I'm watching the rights because I'm waiting for them to drop because I'm looking for buying opportunities because the commercial real estate market's looking horrible. And I was talking about how this is going to happen. And I explained, if you listen to those previous shows, guys, I explained how the contagion will start and trickle down into these rights and why it will provide some good buying opportunities. And I'm glad to hear that Charlie Munger, one of the greatest investors and traders of all time, is following my lead here and going ahead and continuing what I'm saying.
So yeah, you talked about that, and I think it was like the week after I went into how commercial property sector in Europe is failing, and how it may trickle down here into the United States as well. And apparently, Charlie Munger was listening to us, just like Warren Buffett was listening to me, Dave, right before he bought Allegheny Insurance. Remember that when I called that a buy, and then Buffett stepped up and bought it for Berkshire.
I do remember that. I do remember that. It's the Oracle of Omaha is following the chinchillas.
Yes, he is. Yes, he is. That's one thing I want to look out for. I want to watch that when it can and see how that affects banks. I don't really think it's going to affect regionals as much as it would like JP Morgan or Goldman, though. I mean, I might be wrong on that. I don't really follow the banking sector as much as you do, Dave. But yeah, I would pick up PNC on a fall.
So how this the commercial real estate, if it does infect here like it is over in Europe right now, and it's probably going to get a little worse in Europe, but if it does infect here after 2008, especially with real estate, they built in all these safeguards and cash on hand to balance out those real estate and mortgage holdings, and the federal government started buying up all these mortgages every single month after month. We talked about in the show the billions of dollars that our federal government is spending to go ahead and buy mortgages. And so there is some backing there. Since 2008, there's a lot more backing. There's a lot more that the federal government owns, which I kind of want them to unravel and get out of owning those. But at the same time, they put in these precautions to stop that from happening. As far as real estate and mortgage is what I'm talking about. Because everybody would say, well, what happened with Silicon Valley? Everybody's saying they pulled back the regulations and it caused them to do this. I'm like, look, I will say they did pull back the regulations, but that doesn't cause someone to make bad decisions with money. That bank made bad decisions with money because they had poor managers running the show there that were not making effective decisions. Everybody saw the rates and what was going on with the interest rates, and they should have gotten rid of their positions in those bonds, but they did not. That is their fault, their decision, and they should have suffered for it. And instead, we helped bail them out a little bit.
Yeah, well, we were calling this on the show, a year ago, saying this would happen. So how the people with the big money that are in the game, the way they are, didn't see it happening. I mean, it was just so clear to anybody. The Federal Reserve is going to have to raise interest rates, inflation skyrocketing. We're going to have some troubles in the bond market. Not hard to figure out.
Yep, exactly.
How many times have we been through this?
I do. It's experience, and we have a lot of experience here on the show. I know it's just the two of us, but between the two of us, we have 30 years worth of trade and investing, maybe close to that, right? Yeah, we are, but I mean, or at least trade and investing or following the markets of some sort. So I mean, we've seen this before. We're going to see it again. The cycle, the signs are there. You just got to pay attention to it, guys, and really focus in on that. But
go back and listen. There's an episode we did on the market cycle where you can, listen to the episode and kind of, there's some book recommendations in there too that can, shed some light on where we're at right now, where we've been in the past, and where we're going to go in the future. And things, not everything's crystal clear and easy to predict, like the timing of it, like what I was talking about earlier in the show, like it's easy to predict if, not so easy to predict when. But that episode on, I think it's actually has the market cycle in the title or something like that. That could help definitely, and you're investing and trying to figure out, if a recession is going to happen, not as much when, but if, and then if a boom cycle is going to follow anytime soon.
Right. Yeah. You can always tell when I create a title for a show because it just says stocks.
It's generally inflation above 7%, you're in trouble. The Federal Reserve is going to start raising interest rates, and the bull market, for the time being at least, is going to come to an end.
Yeah, and it didn't. It took a while. Everything was just taking a while, and I think there's just other things in place, such as, and we don't have time to get into it, but student loans forgiveness. As soon as everybody has to start paying back their student loans, what's going to happen to the economy?
Yeah.
We've gotten used to not making that payment every single month. But that's a topic for another show. Brandon, final thoughts, man.
I mentioned that 7% because stocks generally outperform inflation unless inflation is above 7%. That's where we were at. Now, whether or not deflation, comes into play and we all start worrying about that because of potential recession, I think it's going to happen. I don't think I'll be wrong about it. I might be wrong about the timing, but that's it. But regardless of all of that, if a stock's cheap, you buy it.
I like that. And if a stock is cheap, you do buy it. One stock that I believe is cheap, and I believe is just being pulled down because sector is being pulled down, is Blink Charging. I know I said I would buy it on our last show, or is it the show before that when it was like $7.40? It's now at $7.01. I still say it's a buy at this point. I think that I see Blink Chargings everywhere. Maybe it's just where we're at here in Ohio, why we're seeing it. But Blink Charging signing a lot of deals. There's other charging companies that are signing deals as well, but Blink is definitely one that is doing well with this. I know I talked about I'll be watching Riot, but I believe Bitcoin is going to be dropping here in the next couple of weeks as the broader market drops. And so Riot would be one I'll be buying into. If Bitcoin drops below 25, I would be very much eyeing it. So that's one I would keep on my watch list, guys. Last time on our final thoughts, I talked about how oil wasn't really, I don't understand why these oil companies were going up when people were making cuts. We're making cuts, and there's a call for the slowdown in the economy. Well, that was 2 weeks ago. And the ones I called out by name, one of them was Transocean Rig, and Rig, sure enough, for the last 2 weeks has gone down, and they actually had a bad quarter results out today. So that is one call I did get right, but I believe it's due to we're going to be producing less oil because the economy is going to have a slow down, and that was my thought behind it. My thought's still there, but they did drop, so now it's like, and now I'm in a neutral position on it.
And that's,
because they did drop.
That's one, people might go out and buy it because the price of oil is going up, but the price of oil is not going up because of demand. It's going up because of supply cuts, which also hurts, that company that what is the company you just mentioned? I'm out of it right now.
Rig, Transocean.
Transocean, yeah. So, even though the price of oil is going up, it's still not good for Rig Transocean because of supply cuts.
Yeah, and that was my same case with Schlumberger, which has a similar track record last 2 weeks as compared with Transocean. But I believe they're down now, so neutral is my call. I'm not saying down anymore. I'm saying they've gone down. Let's wait and see what happens with everything.
In general, they're a good company, but
oh no, they're a great company in general, well run. But it's just when everybody stops drilling and people are saying, hey, we're gonna do cuts in oil output. Well, I mean, when you make your money off of servicing these oil rigs and servicing fields and providing equipment, that's going to hurt your bottom line, your top line. You know what I mean? So it is what it is. All right, guys. As always, we hope we've been entertaining, educational, and uplifting because we want everyone to make money. Have a good night.
Good night.